Tyler, it's been a while since we did a video taking a closer look at NextEra Energy Partners. Just to go back in time a little bit, you called it out right before management slashed their expectations for growth going forward. We warned investors that could potentially happen. It happened. The stock has tanked, yet management has held pretty firm with expectations that they're going to be able to continue to grow the dividend. Yet the market has continued to react with expectations that's not going to be the case, with the stock having fallen so much that the yield is at double digit rates if the dividend that you got last quarter is going to be the dividend they're able to maintain. You ready to give investors an update on our concerns with what's going on and the biggest red flag people need to know right now?
I'm ready to discuss because it comes down to two things: what management says and math.
Yeah, there you go. Okay. The math ain't great right now. Maybe they can fix that. They say they have a plan. We'll see how it works out. I'm Jason Hall. This is Investing Unscripted. This video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should check out our special link. If you haven't already, it's easy to find. Fool.com/unscripted. Again, fool.com/unscripted. Go to that link, and The Motley Fool is going to give you its 10 best stocks to buy right now. Give it a look. So, Tyler, here's the dividend yield for both NextEra Energy in purple. It's over 3%, and NextEra Energy Partners. I bet you can guess, people, when they made the announcement. It's funny, if I pull NextEra Energy Partners off, all of a sudden NextEra Energy's jump up is a lot more obvious. And that's not because they raised the dividend, it's because the stock prices fell a lot. Tyler, what exactly happened?
It's been a confluence of a lot of things. NextEra Energy Partners is an operating subsidiary of NextEra Energy,
It's a
which
financing
next
mechanism. Let's say
yep,
what it really is. It's a financing
yes.
mechanism.
NextEra Energy builds a lot of renewable energy projects and needs a little bit of help on the financing. And so what they do is they drop down, which is based as a fancy word for selling. They sell a portion of those renewable energy assets to this partnership. The partnership gets a stream of cash flows that is separate from what NextEra Energy has, and it becomes a vehicle for investors who want higher yield, but
And it's a
may or
useful way for NextEra Energy to manage its balance sheet while also still having access to renewable energy to
yeah.
meet the needs for its regulated business and also to sell on the unregulated market too.
Yeah, and it's a you could say, like, it needs to maintain its balance sheet, but it's just wrapped it in a whole different security. Even it's got the same name, they're all shared assets or at least, similar developed assets, but it just I guess you could call it pushing the leverage a little bit more because it's an operating partnership, and because of the way that utilities are structured, there's only so much leverage you can take on. Typically, a utility is, especially on the regulated side, typically when they come to those negotiations to with state regulators on how much they want to spend and how much they can raise rates, the state regulator will tell them you can earn this much of a return and you're allowed to basically take out this much percentage of your total capital in debt to do it. Next to our energy partners, you don't have to do that. So you can push the leverage a little bit more. The returns on equity are a little bit higher. You can have a little bit higher yield and then attract investor attention. Now, for this to work, you need a lower yield because to acquire all these assets, you need to take on a lot of debt. You need to issue new equity.
The issue, Tyler, interest rates have skyrocketed. That means cost of capital for taking on debt has moved higher. And the market's expectation that higher cost of capital is going to affect its ability to grow, not even just grow its dividend, but maintain its dividend, has pushed the stock price lower, which has pushed that yield higher, which has locked NextEra Energy Partners out of the capital market in some pretty meaningful ways.
Yeah, and that's been the thing that has led to this much, much higher yield is basically investors started looking at this and saying, wait, if your cost of capital for your debt is going way up and the yield on this is become so prohibitively high that you can't really issue equity anymore, then what do you do to raise capital? And that's where NextEra Energy Partners in September was like, it's okay. We're going to moderate our growth rates. We don't have to take on new equity. We can do this with internally sourced cash flows from just issuing debt, and we're going to be fine. And there was a little bit of the market reacted a little bit to that, but since kind of not, is started to look past the initial assessment and said, after seeing the most recent quarterly filings, that may not work out as they think it will.
So we're going to share the yellow flag here in a couple of seconds. But before we get to it, Tyler, I just want to share this. This is from the fourth quarter earnings that they reported. And this is their expectations for run rate for cash available for distribution, which essentially is what they say. This is their unlevered cash flow that they can use to do things like buy back shares or pay to shareholders in distributions, which is limited partners speak for dividends. Here's the thing. They're saying that in 2024, distributions per unit are going to be $3.73. Last quarter, it was 88 cents a quarter, which is $3.52 a year. They're already saying that they're planning to continue to increase it, right? So they're saying that they're going to be able to do it. Tyler, that's their plan. And again, they've got some lower capital ways to do it, repowering some of their wind farms, for example. You've already got the big investment is made with the infrastructure and that sort of thing, putting more powerful turbines in place to increase the power output and the cash flows from those wind farms is part of their idea. But now it's time for the red/yellow flag. And you mentioned it at the open, and that's math.
So that number that they gave on the guidance for cash available for distribution, they had it in the 730 to 820 range. For 2023, it hit the very bottom of that range. It came in at, I know it's a slightly different number, but cash from operations, which is the accounting kind of thing that we all follow, came in at $731 million. And that's pretty much right at the very bottom end of that, what's available for distribution. Now, maybe management found some other cash under the cushions that made that a little bit higher. Absent a better accounting mechanism than operating cash flow, let's just use this as our gauge, right? In the same fiscal year, so 731 in operating cash flow, they paid 741 in dividends or distributions. So total distributions sent out the door was $10 million more than was actually taken in. And this is on the 2023 dividend. Now, the business can grow. I'm not doubting that in a sense. There, like you said, there's maybe we can reprice some power contracts. There's some cheaper ways to improve output than building a whole new solar farm or wind farm or anything like that. But if we're already plugging in 6% growth on our payout and we sold a significant asset this year, they sold their natural gas pipelines, which were a significant cash generator. Maybe not the thing that's going to make or break the company, but it's enough that it needs to make that up and then some for fiscal 2024. And so
Well,
if you
Tyler, one of the
have
things that they reported under their net income line, and it's not reflected under the cash flows, but it certainly affects the cash flows. Those operating cash flows include the cash flows from that asset. If you look at their income line, if you separate out income from discontinued operations, which are those gas pipelines that they're selling, the company actually generated an operating loss, right? So it's important to note that is going to take a pretty material bite out. Now they're using those proceeds to pay down debt, right? Which is healthy, which they need to do, that it is going to reduce some debt. But the point is the math is still not favorable, right?
yeah, we're paying down some debt, which is nice, but at the same time we're taking away a major cash producing asset. Expectedly, cash from operations is probably going to go down and you're also going to increase your payout, which widens that $10 million gap that we already had in 2023. And so,
There's more to
again,
it too, Tyler, and that's the other part of the math. It's not just operating cash flow and dividends. Sure, they can grow some to offset some of that. The thing that we haven't mentioned yet is that's refinancing expense. Their existing debt that they're going to refinance that they're not paying off, that's just going to mature in coming years. They're going to have to refinance it at much higher rates than they're paying right now. So that's another cash out the door cost that's going to have to be accounted for somewhere.
so there's a lot of material headwinds to the cash coming in the door. And right now, we're not even talking about spending on anything else. We're not talking about spending on capital investments. We're not talking about any plans for growth, any plans for maintenance. Any dollar spent to maintain or grow this business right now is going to have to come from external financing or equity or whatever have you, because right now, the current payout for the business is greater than all the cash coming in the door. That is unsustainable. There has been no business in the history of business where if I pay out more in distributions than what I bring in for more than, I don't know, however long I can keep it going with external financing, it blows up. It has every time. And now I'm not saying this is going to happen. All of these things tend to point that management plan for a continued distribution growth is not going to happen. And I would not be shocked in the slightest by the end of this year that we actually hear an announcement of a dividend cut.
I own some shares. I think that the likelihood of a dividend cut is high, but like I said, I think it is pretty well already priced in to where the stock is right now. So I don't think the market would necessarily be shocked and send the stock down a lot unless you're an income investor. That's where the risk lies. If you're investing in this because you're counting on that 11% yield for income that you need, that's a high risk move. If you're investing based on some risk reward, okay, I can understand that. Tyler, let's just take a minute or two here and talk about a stock in this area that we think is investable right now with a supportable dividend and the ability to grow that payout. I'm going to go first and talk about one that I think has a little better risk reward appeal right now, a dividend that I think is probably safe. It's definitely on the higher end of the yield, but I think the payout is probably safe. And it's a business that has become, to me, more and more appealing as the stock prices come down, pulled down a little bit by everything that's happened with NextEra Energy Partners, and that's Clearway Energy. It has two really big partners that I think bring a lot to the table in terms of being the top of the, and those two partners are global infrastructure involved in a lot of infrastructure investing and also Total Energies. Those are its two sponsors. Total is, of course, the French based super major, energy super major that has a lot of alternatives that it's involved in, and on top of the traditional oil and gas business. They look at Clearway as a partner mechanism to invest in these deals and not just a drop down refinance mechanism like we see with NextEra Energy Partners. Dividend yield is about 7.5% on the higher end right now, but I think the payout is safe, and I think their ability to grow it, they're not going to grow it fast, but I think their ability to maintain the dividend is pretty solid. So I think Clearway Energy deserves a closer look right now than NextEra Energy Partners does. Tyler, what about you?
I'm going to go with Alette, which used to be called Minnesota Power. It's the utility for the state of Minnesota. If people who are very much interested in renewable energy, because they're invested in Nexar Energy Partners, they'll be impressed to see that Alette has the highest percentage of renewable megawatts per market cap of any utility in the country. So basically, the amount of renewable power you're buying per market cap is the highest you can get anywhere out there in utility space. Unlike NextEra Energies, this is actually a business that's been deleveraging over the past 10 years. It went from a debt to capital somewhere in like the 45, 46 range down to 32% today. And over the next 5 years, they have their most recent updated capital plan is to invest $4.3 billion in regulated renewable and transmission projects. And so, just to give a context to that, this is a $4 billion investment plan over the next 5 years for a $3.8 billion utility. So, there is substantial growth being built into this business that is in a good financial place to do that. And for a utility that currently has a dividend yield of 4.8%, trading at about 13 times earnings, that is to me a much more attractive kind of utility stock or renewable power stock that I would want to be invested in today than, say, NextEra Energy Partners.